I've said it before, I'll say it again. The first rule of compounding is to never interrupt it unnecessarily. And the fastest way to interrupt compounding is to lose money. It sounds obvious, too obvious, like telling someone not to stick their hand in a fire. But the world is full of people with burned hands. I've been investing for more than half a century. I've seen markets rise, collapse, recover, and collapse again. I've seen geniuses go broke and ordinary people get rich. And if I had to boil it down to one idea, it's this. The people who survive are the ones who avoid stupidity better than they chase brilliance. Let me give you an example. In the 1930s, I was a kid in Omaha. The Great Depression was not some chapter in a history book. It was life. Men with good jobs were selling apples on the street. Families were losing their homes. You could buy a nice farm for the price of a used car. The lesson was simple. If you took on debt and the tide went out, you drowned. If you stayed conservative, you survived. I watched families destroyed not by bad luck, but by overconfidence. They thought tomorrow would look like yesterday. It didn't. The Depression cured me of optimism about human rationality. People don't learn as quickly as you'd hope. Fast forward to the 1970s. Inflation was eating people alive. Stocks collapsed. Oil prices quadrupled. Once again, many so-called smart people lost fortunes because they borrowed too much, believed too much, and thought they were entitled to easy wealth. I wasn't a genius. I was just cautious. I avoided debt. I avoided hot tips. I avoided chasing whatever was fashionable. And because I avoided losing big compounding, worked quietly in the background, year after year, decade after decade. It's worth repeating. Not losing is more important than winning. People hate hearing that. They want to win big. They want to triple their money by Tuesday. That urge destroys more wealth than poverty ever did. Think about the gamblers in Las Vegas. The lights on the strip are not paid for by winners. They are paid for by losers who thought they had a system. The stock market is no different. The casinos are just bigger and better dressed. I remember once investing in a company that looked cheap, a real cigar butt deal. You know, the type 1 puff, left, and maybe you get a free smoke. Well, the smoke was free, but the stink stayed with me for years. I learned to stop buying garbage just because it looked cheap. Cheap junk is still junk. That mistake probably cost me more money than I care to count. But it taught me something better than any textbook. The price of avoiding stupidity is much lower than the price of fixing stupidity. So if you want to know how to never lose money, start by cutting out the obvious disasters. Don't borrow money you can't repay. Don't buy what you don't understand. Don't trust people who make money selling advice. And don't ever believe you're smarter than the market. You can make a fortune simply by surviving. Warren and I never tried to get rich quick. We just tried not to go broke. That small difference compounds into something enormous over a lifetime. So here's my advice. Forget brilliance. Forget being clever. Forget trying to outsmart everyone in the room. Just make fewer dumb mistakes. That alone will make you rich. And if you don't like the sound of that, go ahead and chase the next hot stock tip. The market will be happy to take your money. If you want to ruin your life and your portfolio, envy will do the job faster than any market crash. Envy is the dumbest sin. Why? Because it doesn't even make you feel good. Lust can be fun. Gluttony at least tastes good. Pride feels nice for a while. But envy is like drinking poison and waiting for the other person to die. I've watched people make perfectly good money, live perfectly decent lives, and still end up miserable because someone else did slightly better. Their neighbor drove a nicer car, their classmate bought a bigger house, their colleague got rich faster. Suddenly they were no longer content. They started taking stupid risks just to catch up. That urge destroys investors. Instead of sticking to sound principles, they chase whatever seems to be working for someone else. Tech stocks in the 1990s, real estate in 2006, crypto in 2021. Different years, same stupidity. Warren and I never wasted much time on envy. We didn't care if someone else doubled their money while we were sitting still. We knew sitting still with the right asset was often the smartest move. It's not easy, but it's simple. Back in the dot-com bubble, the late 1990s, everyone was bragging about internet stocks. We looked like fools for not joining. Some of those stocks went up 10 times in a year. Our friends were paper rich while we looked boring and old-fashioned. Well, a couple of years later, most of those paper fortunes turned into ashes, and boring old Berkshire Hathaway kept compounding. Envy cost those people fortunes. They weren't satisfied with their own game, so they copied someone else's badly. They thought they could leapfrog their way to glory. Instead, they jumped off a cliff. Envy also makes people miserable long before it makes them broke. I've known rich men who couldn't enjoy their yachts because someone else had a bigger one. That's not living, that's slavery. One of my favorite lines is, "Someone will always be getting richer faster than you, so what?" That attitude will keep you sane. It might even keep you alive. The truth is, most envy-driven moves look like brilliance for a short time. You get lucky, you brag, people think you're a genius. Then the tide goes out, and suddenly you're exposed naked, broke, and embarrassed. Here's the punchline. You don't need to win every race. You only need to avoid losing your shirt. The person you envy today might be bankrupt tomorrow. And if you're sensible, you'll still be standing. So the cure for envy is simple. Stop looking at the scoreboard. Focus on your own game. The race is long, and most runners won't finish. Your only job is to stay in the race without tripping over your own stupidity. That's how you win, by not trying to keep up with the idiots. I've made plenty of mistakes, some small, some expensive, and one or two that probably cost me a fortune. People like to imagine that Warren and I sat in an ivory tower making perfect decisions all day. That's nonsense. We screwed up plenty. We just avoided the kind of screw-ups that put you out of business. One mistake I still think about was underestimating how valuable some businesses would become if left to compound for decades. We passed on things that looked too expensive at the time, Coca-Cola, before we bought it, for example. It wasn't a disaster, because we did buy Coca-Cola later, but we could have made much more if we had acted sooner. That's a common mistake among investors, being too focused on the price tag and forgetting the quality of the business. Buying junk just because it's cheap or ignoring greatness because it looks expensive. Both are costly. Let me give you another story. Years ago, I bought into a company that was a so-called cigar butt. It looked like a bargain. One last puff left. The numbers were cheap, and I thought I was being clever. Well, the company was cheap for a reason. The business was rotting. I made a little money, then lost it, and wasted years that could have been spent in something better. That mistake cured me of cigar butts. They may give you a free puff, but they leave a bad taste. Far better to pay a fair price for a great business than a cheap price for a lousy one. I can almost hear the chorus of young investors saying, "But Charlie, I don't want to overpay." Here's the thing, overpaying for quality is still safer than underpaying for garbage. Garbage goes to zero. Quality compounds. The real mistake isn't paying 20% too much for Coca-Cola. The real mistake is never buying Coca-Cola because you were too busy hunting for bargains in the trash heap. Now don't misunderstand me. Discipline still matters. We didn't go around paying ridiculous prices just because we liked the brand. But when we saw a fortress business with staying power, we learned not to get too cute. That lesson cost me millions to learn. The key takeaway: the big money isn't in the buying or the selling, it's in the waiting. And you can't wait on a lousy business because time is the enemy of garbage. Time is only a friend of great businesses. So when people ask me, "Charlie, what's the worst mistake you ever made?" I usually tell them, it wasn't the money I lost, it was the money I never made because I underestimated the obvious. And if you want to avoid losing money, don't just avoid disasters. Avoid wasting decades on mediocrity. That's the quiet mistake that robs more investors than crashes ever will. The market punishes the impatient, but it also punishes the blind bargain hunter who thinks price matters more than quality. It doesn't. In investing, you don't get paid for being clever. You get paid for being consistently not stupid and realizing that early is worth millions. If you want to know why most people lose money, it isn't bad luck. It's overconfidence. They think they know more than they do, and they act on it. I've watched men sit in boardrooms certain they could outsmart the world. They'd say things like, "This time it's different," or "The old rules don't apply anymore." Every time I heard that, I knew trouble was coming. Confidence is fine. Arrogance is fatal. Most people don't realize how limited their circle of competence is. They read a few articles, talked to a broker, or watched some TV pundit, and suddenly they think they understand the oil industry, tech stocks, and foreign currencies all in one afternoon. That's how fortunes vanish. Warren and I stayed rich by admitting what we didn't know. It sounds dull. It even sounds weak. But knowing your limits is one of the most powerful edges in investing. Take airlines. We avoided them for decades. They looked like death traps, capital intensive, cyclical, union problems, fuel costs, all working against investors. We knew we weren't smart enough to pick the winners in that mess, so we stayed out. That one decision saved us from a century of disasters. Of course, later on we bought some airline stocks thinking the industry had changed. That was a mistake. The business didn't change. We just let our guard down. Fortunately, we didn't bet the farm. We lost a little, shrugged, and moved on. Here's the lesson. Overconfidence makes you double down when you should walk away. Admitting ignorance makes you live to fight another day. One of the most dangerous sentences in investing is, "I can't miss." The moment you think you can't miss, you already have. Think about the dot-com bubble. Late 1990s, everyone thought they were a genius. College kids were day trading in dorm rooms. Taxi drivers were giving stock tips. People said things like, "Profits don't matter anymore." That kind of delusion is fueled by overconfidence. And it ended the way delusions always end badly. I don't mind looking stupid for avoiding something I don't understand. I do mind looking stupid for betting big on something I never understood in the first place. The cure is humility, not the fake kind where you pretend to be modest while secretly believing you're brilliant. Real humility, the kind that says, "I don't know and I don't need to know." That's the real secret to never losing money. Admit what you don't know, and don't play games outside your circle of competence. You don't need to swing at every pitch. You only need to swing at the ones you understand. So if you want to avoid losing money, get rid of the idea that you need to have an opinion on everything. Nobody cares what you think about oil futures, cryptocurrencies, or interest rates in Japan. If you don't understand it deeply, shut up and sit still. That discipline alone will keep more money in your pocket than 1,000 clever opinions ever will. One big reason people lose money is that they think like employees instead of owners. They optimize for the next quarter, the next promotion, or the next bonus, not the next 20 years. Careerism makes people play it safe in all the wrong ways. They protect their job instead of protecting the business. They protect their ego instead of protecting their capital. I've sat on enough corporate boards to see how this game works. Executives talk endlessly about strategy and growth initiatives, but what they really care about is whether their stock options will vest before reality catches up. That's why companies spend billions on buybacks at the top of a bubble and cut investment at the bottom of a cycle. They're playing for applause, not survival. Warren and I always thought like owners. We didn't care if our decision looked good next quarter. We cared whether they would still look good 20 years later. Take See's Candies. We bought it in 1972. At the time, plenty of analysts said we overpaid. If we'd been thinking like careerist executives, we'd have worried about what the press or the analysts would say next quarter. But we thought like owners. We knew the brand was strong, the customers were loyal, and the moat was real. Half a century later, that overpriced deal looks like one of the best investments we ever made. Now compare that to the people running most public companies. They'll happily chase acquisitions to make their empire bigger, even if the acquisitions are lousy. Why? Because bigger companies mean bigger salaries and more prestige for them. Owners don't think that way. Owners care about return on capital, not square footage in the annual report. Another example, newspapers. Back in the mid-20th century, they were phenomenal businesses. High margins, local monopolies, strong advertising base. Then the internet came along. An owner would have asked, how do we adapt? How do we preserve our moat? A careerist just rode the wave until their retirement package was safe. The result? A whole industry gutted and shareholders left holding the bag. If you want to avoid losing money, ask yourself one question every time you look at a business. Are the people running it thinking like owners or like careerists? If they're owners, they'll sacrifice today to build tomorrow. If they're careerists, they'll sacrifice tomorrow to make today look good. I've watched brilliant engineers and marketers build great products only to have careerist managers ruin everything by chasing quarterly numbers. And I've watched boring candy makers quietly compound into billion-dollar franchises because the owners cared about customers, not headlines. So what's the lesson for you as an investor? Don't just look at balance sheets and growth rates. Look at the incentives. Show me the incentives, and I'll show you the outcome. If you bet on careerists, don't be surprised when your money disappears. If you bet on owners, don't be surprised when patience makes you rich. The market may look complicated, but half the time it's just human nature in disguise. And human nature doesn't change. Careerism rounds. Ownership builds. So don't play the careerist game. Play the owner's game. That's how you keep from losing. If you really want to understand why I talk so much about avoiding loss, you have to start with the Great Depression. I was a kid then, growing up in Omaha in the 1930s. It wasn't a classroom. It was survival training. You didn't need lectures on risk. You could see it on every street corner. Men who had good jobs one year were standing in soup lines the next. Families were evicted from their homes. Kids wore the same patched clothes for years. I saw what happens when people live right up to the edge and then the edge crumbles. Debt was the big killer. People thought tomorrow would look like yesterday. They borrowed against a future that never came. When the bottom fell out, they were wiped out. Those memories never left me. They made me allergic to debt, allergic to speculation, allergic to relying on rosy assumptions. The world can turn against you in ways you can't imagine. If you're not prepared, you won't just lose money, you'll lose your dignity. Fast forward to the crash of 1973 to 74. It was the worst bear market since the Depression. Stocks dropped by more than 50%. Once again, people who had borrowed too much were ruined. It wasn't intelligence that saved the survivors, it was prudence. The Depression also taught me that cash is underrated. In good times, holding cash looks stupid. People call you timid. In bad times, holding cash makes you the only person in town who can buy. And the bargains during bad times can set you up for decades. That's how Warren and I operated. We were never ashamed to hold cash while everyone else rushed to buy. We waited until fear made assets cheap, and then we moved. That habit came straight out of watching the Depression play out in real time. Another lesson, resilience matters more than brilliance. I've known plenty of clever men who didn't survive tough times because they never prepared for them. Meanwhile, the boring conservative families who lived below their means, they got through it just fine. It's fashionable today to glorify risk-taking. Everyone wants to be bold, disruptive, leveraged to the eyeballs. Well, I saw what happened to the last generation that thought the future was guaranteed. They ended up broke, bitter, and forgotten. That's why Warren and I always emphasize staying power. It doesn't matter how smart you are, how great your models look, or how fancy your MBA is. If you can't survive the bad times, you won't be around for the good times. And make no mistake, the bad times always come. They don't announce themselves. They don't follow your calendar. They just show up one morning and take half the market with them. So here's the point. The Great Depression wasn't just history to me. It was a scar that reminded me every day that the most important rule is to never lose big. Lose small if you must, but never lose so much that you can't come back. That scar has served me well. And if you want to keep your money, maybe you should borrow the lesson. If you really want to stay rich, or at least avoid going broke, learn to avoid three things: debt, drama, and dumb people. Let's start with debt. Debt is like a loaded gun. It can kill you, even if you think you're being careful. One bad turn, one crisis, one unexpected event, and suddenly you're insolvent. I watched it happen during the Depression, again in the 1970s, and again in 2008. The people who survived were the ones who didn't borrow money they couldn't repay. Leverage looks smart in good times and suicidal in bad times. Now, drama. By drama, I mean unnecessary complexity, chaos, and emotional baggage. I've seen entire companies destroyed by feuds between executives who couldn't stand each other. I've seen investors ruin themselves chasing get-rich-quick schemes because they couldn't resist the thrill of action. Drama wastes energy, clouds judgment, and blinds you to simple truths. Business should be boring. Investing should be boring. If you need excitement, go bet on horses. And then there are dumb people. Avoid them like the plague. Life is too short to tie yourself to incompetence, dishonesty, or bad character. I'd rather work with a mediocre business run by honest, competent people than a great business run by crooks. Bad partners can ruin you faster than a bad market. Take the Salomon Brothers scandal in 1991. The firm nearly went under because of one trader's reckless, dishonest behavior. Warren had to step in to keep it afloat. That episode taught us again what we already knew. One dumb or dishonest person can put the entire ship at risk. Avoiding dumb people doesn't mean surrounding yourself with geniuses. It means sticking with people you can trust, people who have integrity, people who don't need constant babysitting. It also means avoiding people who are addicted to drama. They'll drag you into their chaos. This is simple advice, but it's powerful. Don't overcomplicate your life with debt. Don't burn yourself out with drama. Don't let dumb people take the wheel. If you avoid those three things, you've already tilted the odds massively in your favor. Not because you'll be smarter than everyone else, but because you'll have fewer self-inflicted wounds. Remember, the first rule is don't lose. And the fastest way to lose is to ignore these three hazards. Most people are busy chasing the next big opportunity. I'm more interested in dodging bullets. Survival first, wealth second. That mindset alone will keep you out of a lot of trouble. So, if you want a shortcut to financial survival, here it is. Less debt, less drama, fewer dumb people. It doesn't sound glamorous. It doesn't make headlines, but it works. And unlike the advice you'll get from Wall Street, this advice won't make me a dime if you follow it, which is probably why it's worth listening to. People like to romanticize my partnership with Warren. They imagine two geniuses in a room pulling magic ideas out of thin air. That's nonsense. What really worked was discipline, patience, and a refusal to do stupid things. Warren and I didn't agree on everything. He liked buying cigar butts in the early days, companies so cheap you might squeeze one last puff of value out of them. I told him it was a dumb way to live. Better to buy wonderful businesses at fair prices than garbage at giveaway prices. Eventually he agreed. That shift in thinking changed Berkshire Hathaway forever. What did work between us was temperament. We were both willing to look foolish for long stretches of time. When everyone else was chasing dot-com stocks in the late 1990s, we sat on our hands. We looked like idiots for about 2 years. Then the bubble burst, and we looked like geniuses. Another thing that worked was trust. I never worried about Warren stabbing me in the back, and he never worried about me. That saved us enormous amounts of energy. We could focus on investing instead of politics. Try finding that in most corporate partnerships, it's rare. We also had complementary skills. Warren was the master of insurance, capital allocation, and spotting deals. I was better at pushing him to think about quality businesses and long-term moats. We sharpened each other's thinking. That's what a good partnership does. Now, what didn't work? We made mistakes, plenty of them. We bought into airlines thinking the industry had finally improved. It hadn't. We lost. We passed on Microsoft even though we knew Bill Gates personally. That decision probably cost us tens of billions. But we didn't beat ourselves up. You can't play this game without making mistakes. The key is to avoid the kind that kill you. Another thing that didn't work was trying to predict the future in detail. We never knew where oil prices were going or what interest rates would do next year. When we tried guessing, we were usually wrong. So we stopped guessing. Instead, we bet on things that didn't require prediction. Strong businesses, good managers, and durable moats. What kept us alive wasn't brilliance. It was a shared allergy to stupidity. We didn't need to be the smartest men in the room. We just needed to avoid being the dumbest. And over time, that philosophy compounded into something extraordinary. Not because of perfect moves, but because of fewer disastrous ones. The punchline is simple. A good partnership doesn't eliminate the mistakes. It just makes sure the mistakes don't sink the ship. That's what Warren and I managed to do for over half a century. It worked. Not perfectly, but well enough to turn Berkshire into one of the greatest compounding machines in history. And if you want to know the secret, it wasn't magic. It was trust, patience, discipline, and the willingness to look boring while everyone else was busy losing money. Here's the truth most people don't want to hear. I never had a grand plan to become a billionaire. It just happened because I avoided enough dumb mistakes and let compounding do the heavy lifting. That doesn't sound exciting, but it works. Most fortunes are built slowly, almost invisibly, while everyone else is chasing excitement. The people who get rich quick usually lose it just as quickly. I didn't swing at every pitch. I didn't gamble on things I didn't understand. I didn't borrow money just to look smart. Instead, I kept my costs low, held cash when nothing looked good, and waited for opportunities where the odds were stacked in my favor. You don't need brilliance to do that. You need patience. And patience is in short supply. Look at the average investor. They read headlines, panic when prices drop, and get greedy when prices rise. They're always chasing something: hot stocks, hot sectors, hot tips. The result is predictable. Buy high, sell low, repeat until broke. Meanwhile, the people who quietly keep their spending below their income, avoid debt, and invest in durable businesses, they end up wealthy almost by accident. They don't brag about it, but they don't need to. Wealth that lasts doesn't come from bragging. When people ask me for the secret to getting rich, I tell them there isn't one. Spend less than you earn. Invest in things you actually understand. Sit on your hands when there's nothing to do. And for heaven's sake, don't lose big. That's it. No magic formulas, no stock picking wizardry, no shortcuts. If that disappoints you, good. It means you're probably looking for excitement, not wealth. And excitement is a terrible investment strategy. Warren once said, "It's not supposed to be easy. If it were easy, everyone would be rich." I'd add, it's not supposed to be exciting either. If you're entertained, you're probably doing it wrong. The surprising truth is that staying rich is easier than getting rich. Why? Because once you have a decent base of capital, you only need to avoid disaster. You don't need to double your money every year. You just need to not blow it. That's why I laugh at people who think they'll make it by trading in and out every week. That's not investing, that's just paying more commissions. Real wealth comes from sitting still with the right asset for decades. So if you really want to know how to never lose money, stop trying to get rich quick. Focus on surviving. Survival over time will do the compounding for you. It's dull, it's slow, and it's the only strategy that actually works. After 99 years on this earth, I can tell you the secret to not losing money isn't complicated. It's discipline. Note brilliance. Note genius. Disciplina. The first rule is don't lose. The second rule is don't forget the first rule. Everything else is just commentary. I've seen empires collapse, bubbles inflate and burst, and entire industries disappear. Every time, the people who survived were the ones who avoided the obvious mistakes. They didn't borrow recklessly. They didn't chase fads. They didn't let envy, arrogance, or greed run the show. They lived below their means, bought things they understood, and partnered with people they trusted. That was it. Boring? Yes. Effective? Absolutely. I didn't plan to become a billionaire. I just tried not to go broke. And by overshooting on prudence, the results took care of themselves. You don't need to be a genius to follow that rule. You just need the strength to ignore stupidity, your own and everyone else's. And believe me, the supply of stupidity never runs out. Here's the final punchline. If you're not spending less than you earn, if you're not avoiding debt, if you're not staying inside your circle of competence, then I can't help you. Nobody can. The market is brutal. It doesn't care about your hopes or your excuses. It only cares whether you survive long enough for compounding to work. So ask yourself, are you building your life and your investments on survival or on luck? Because luck runs out, survival doesn't. I leave you with the same advice I lived by. Forget brilliance. Forget clever tricks. Forget shortcuts. Just don't lose. That rule alone is worth more than all the investment books in the world. And if that sounds too simple for you, you'll probably learn the hard way. The market has a perfect cure for arrogance. It's called bankruptcy.